All right, welcome back. We are on day 9. Today, we're going to pull back the curtain on something most people only figure out the hard way. We're talking about the real cost of being in the market. You know, where your money goes before it even gets a chance to grow. So let me just ask you a simple question. You buy a stock, and hey, it goes up 3%. You made money, right?
Well, the answer is not necessarily. And honestly, understanding why is probably one of the biggest leaps you're going to make as an investor.
Yesterday, we talked all about that risk versus reward framework, but there's this hidden layer to it that most people just miss. You see, before your investment makes even a single rupee of profit, it's already paying a bunch of people just for the privilege of playing the game. So let's start with the most common situation, right? You buy a stock, and you plan to hold it for the long term. This is what's called a delivery trade. You'd think it's pretty straightforward, but nope, there are costs baked right in. So even with all those brokers yelling about zero brokerage, you just can't escape these. These are mandatory charges coming from the government, the stock exchange, and the depositories, the places that hold your shares for you electronically. They're tiny little percentages, but they are absolutely unavoidable on every single trade. So what does that actually look like in real money? Well, on a simple 10,000 rupee trade, that's you buying and then later on selling, you could easily pay between 30 and 60 rupees in total charges. Just think about that for a second. That money is gone before you've made a single rupee of profit. It's literally the entry fee to the game. Okay, now let's switch gears and see how this whole thing builds up for someone who's a bit more active, like an intraday trader. For them, the cost structure changes, and how often you trade becomes the absolute key factor. Most of the discount brokers you see charge a flat fee, maybe 20 rupees per order. Sounds tiny, right? But just watch how quickly it stacks up. 1 trade, 20 rupees. 2 trades, 40. Do 5 trades, and you've already spent 100 rupees. And get this, that's just for buying. When you sell those 5 positions, that's another 100 rupees. All of a sudden, 5 little round trips have cost you 200 rupees. And this right here is the very first hurdle every single trader has to clear. That 200 rupees, that's your daily break-even point. You literally start every single day in the red, and your trading strategy has to be good enough to climb out of that hole just to get back to zero. Now let's venture into the world of futures and options, or F&O. This is where the impact of these costs becomes even more critical, and to be honest, it's pretty dangerous if you choose to ignore them. In F&O, sure, you've got your brokerage fee per order, just like intraday trading, but you've also got STT and other charges. The thing is, the individual costs look so small, they're almost invisible. But the defining feature of F&O trading is incredibly high volume. Traders often make dozens of trades a day, and those tiny, tiny costs just multiply with every single click. And this leads us to a pretty shocking statistic. SEBI, the market regulator, actually found that over 90% of individual traders in F&O lose money. And it's not always from one huge, dramatic loss. More often than not, it's a death by 1,000 cuts, tiny transaction costs that just completely eat away at any small profits they might have scraped together. Okay, let's shift gears from all that active trading and talk about something that affects millions of long-term investors, mutual funds. There's this persistent, quiet cost hiding in plain sight here that so many people just completely forget about. It's called the expense ratio. The easiest way to think about it is like an annual management fee. It's a small percentage of your total investment that the fund company just automatically deducts every single year to pay for their salaries, their research, all their operating costs. And this is why it matters so much. A 1.5% expense ratio on a 5 lakh investment means you're paying 7,500 rupees every single year. But here's the real kicker. You pay this fee whether your fund made you money or lost you money. It is a guaranteed cost you pay against a completely uncertain return. So, after all those costs, the brokerage, the transaction charges, the expense ratios, you think you're done, right? Nope. There's one final and often the largest haircut that your returns are going to take: taxes. Now, the rules are different depending on how you play the game. If you hold stocks for more than a year, your profits get taxed at a lower long-term capital gains rate. But if you hold for less than a year, it's a higher short-term rate. And for our intraday and F&O traders, those profits are treated as business income, which means they get taxed at your personal income tax slab rate. That can be as high as 30% or even more. And all of this leads to a really powerful insight. The market isn't expensive because you might lose on a bad trade. It's expensive simply because you participate. Every single action you take has a cost attached. So I want you to remember this. That green number you see on your trading screen, that is not your real return. Your real return is what's left over after brokerage, fees, and taxes have all taken their cut.
And let's connect this right back to yesterday's lesson on risk versus reward. So say you're aiming for a 200 rupee profit on a trade, but your total costs to get in and get out are 80 rupees. Well, your real potential profit, your actual edge isn't 200 rupees, it's only 120. See how that changes the entire calculation?
So, knowing all this, how do you change your approach? How do you go from being just a typical participant to a smart one? Well, it all starts by asking the right questions before you even think about clicking that buy button. It really just comes down to asking two simple things before you do anything. First, what are my total costs to get in and out of this position? And second, is my potential return actually big enough to comfortably beat those costs? See, most people only look at the potential profit. Smart participants look at the profit after costs. And I want to leave you with a question. Be honest with yourself. Before today, did you know about all these different layers of costs? Did you know about things like DP charges? If the answer is no, that's okay. It just means you've already taken a massive step forward today. So now you understand the real costs of the market. Tomorrow on day 10, we're going to zoom out. We're going to meet all the other players in this giant ecosystem, from the huge institutions to people just like you. You're going to find out who you're really up against. I'll see you then.